Next problem on our list for chapter 4 is E42. E42 gives us an adjusted trial balance, and it asks us to review that trial balance and then determine based on that information 2 examples of potential deferral adjustments, okay? And then 2 examples of potential accrual adjustments. We don't have to do any sort of computation. It just wants us to come up with some examples. So you only had to write 2, but I've listed some out here for you, and there could be others too, but here's some listed out here, okay? First thing, look at, if you look at the trial balance that you're given and you scroll down to about the 4th line down, you see we have prepaid expenses. I've listed out here prepaids. Notice that prepaids could be things like prepaid insurance, prepaid rent, things you've paid in advance. Well, if you've used those, right, it would require an adjustment. That adjustment would be a deferral adjustment. Why? Because when we originally bought it, when we originally paid in advance, we debited prepaid and credited cash, right? There was a journal entry where we actually recorded something on the balance sheet. Remember how I told you we have a previous journal entry, right? Well, as we use that up, we'd have to make a deferral adjustment. So this could be one of them, and then the other side to that would be an SG&A expense, noticing some type of expense. SG&A covers a lot of different expenses. It stands for selling, general, and administrative expenses, okay? So it could include things like rent expense. It could include things like interest expense. So that would be the other side of the potential journal entry. The next one I have listed out for you is accumulated depreciation. Remember, we introduced this concept of depreciation in chapter 4, in which we take a piece of equipment or a building or some sort of asset with a long life, and we recognize the use of that asset over time because it's used for longer than a year. Remember, depreciation is not a decline in value. Depreciation is not a payment of cash. Depreciation is an accounting term when we're using it in the accounting context to recognize the use of some sort of asset over a period of time, okay? So when we record the original purchase of that asset, let's say we bought equipment, we would have debited equipment, and let's just say we paid cash for it, and we credit cash. We're placing this on the balance sheet, right? We're placing this cost on the balance sheet until we can use it to generate revenue and then match the expenses with the revenue, right? So it will require a deferral adjustment as we use it. That deferral adjustment would debit depreciation expense, credit accumulated depreciation. And I have here listed SG&A expense because SG&A expense could include depreciation within it, okay? So just working with the account titles that we were given. On this trial balance here, they give us SG&A expenses, one of the groupings and expenses which could include depreciation expense. All right, the next one here is unearned revenue, okay? If you go down to the liability section on the adjusted trial balance, you'll see that we have other current liabilities listed out here, okay? Other current liabilities could include something like unearned revenue. They don't give us that specific title, but other current liabilities is a little bit ambiguous, so it could include something like unearned revenue. If it did, initially when we received some sort of consideration, we'll say cash, okay, we would have debited cash and we would have credited unearned revenue because we hadn't yet done anything. Again, making that previous journal entry, placing something on the balance sheet. Then, when we actually earn it, we would debit unearned revenue and credit some sort of revenue account. And that would be the deferral adjustment here. Notice again, deferral adjustments have a previous journal entry associated with them, okay? So here's some examples just by looking at that trial balance. You need to set your mindset so that you can look at an account and say, hey, this must have had a previous journal entry to establish that account balance. Therefore, there might be a deferral adjustment associated with that. I need to check the information to see if we need to make an adjusting journal entry, okay? Going on to requirement number 2, it asks us to look at some accrual adjustments. Remember, accrual adjustments don't have a previous journal entry associated with them, but there is an event that takes place and therefore requires an adjusting journal entry. Okay? In this instance, we kind of have to use some thought into what those events could have been. What events might have taken place and required an adjusting journal entry. Because remember, there's no calculations associated with this problem. We're simply just determining, could there have been an adjustment required? Okay? So, first one I have listed out for you is accounts receivable and revenue. It gives us accounts receivable as one of the accounts specifically listed out, and gives us sales revenue as one of the accounts specifically listed out. Notice that in previous problems that we've worked, we've had an accrual adjusting journal entry to debit accounts receivable and credit some sort of revenue, right? When we have earned revenue but have not yet received anything, okay? So that could be an adjusting journal entry that we have to do, an accrual adjusting journal entry. Another one we have listed out here, interest revenue. If you scroll all the way to the bottom here, the second to the last account you have listed out in this trial balance is interest revenue. You also have listed out an ambiguous account for other assets. Well, since we have interest revenue, we might also have within other assets interest receivable, right? So we've done this journal entry as well in previous problems that we've worked, debiting interest receivable, crediting interest revenue. So it takes a little bit of thought when you look at the trial balance and you see an account like interest revenue, you have to think, oh, they must be earning interest at some point in these periods, right? So we might need to make an adjusting journal entry for interest that's been earned but not yet been paid, right? So that would go to the interest receivable account. The next one that I have listed out here is accounts payable and SG&A expense, and this could be almost anything, right? At the end of a period, one of the things that accountants do is they search for unrecorded liabilities. Where are items where we've incurred a cost, we've incurred some sort of expense, but we've not yet paid it, right? If we find those, if we find invoices where we've received some sort of service or product, but we've not yet paid for it, we would debit some sort of expense account, right? Let's say we had a repair and maintenance account. Okay? Debit, repair, and maintenance expense. Credit accounts payable. Okay? Some sort of expense with accounts payable. That's why I have SG&A expense. It can include a lot of different things. But you have some sort of expense that you've incurred during the period, but you haven't yet paid, so it would go to accounts payable. So that could be another accrual. Again, no previous journal entry, but we now have to make a journal entry if we find that an event like this has occurred. Next one I have listed out here is wages payable. Okay, wages payable is given to us as one of the specific accounts listed on the trial balance. When you have that account, you know that you also could have had wage expense. Why do we have wages payable? Well, that is when employees work, okay, but they have not yet received pay. Okay, wages payable. Let me give you an example. I think I've used this in a previous problem that we've done, but give you kind of a specific example of when this might occur. Let's say that employees get paid every 2 weeks, right? Or twice a month even. We can use twice a month. So they get paid on the 1st and on the 16th. Those are their two pay dates. Every single period they get paid the 1st and 16th, right? Well, when do we produce financial statements? We produce financial statements at the end of the period, right? So we might have to make an adjusting journal entry because we've not yet paid them, but they have worked. Why? Let's say on the 30th, right, we need to make financial statements, or on the 31st, we need to make financial statements. Well, we don't pay them until the 1st. So we haven't yet made journal entry, but they've worked from the 17th all the way to the 30th or the 31st, right? So we'd have to make a journal entry to debit wage expense because the employees have provided a service, and credit wages payable because we owe them. We now owe them, okay? So that'd be an example of that. The last one I have listed out here is income tax payable and income tax expense. Notice that income tax expense is the very last line listed on the adjusted trial balance, okay? So we also have a specific line for income tax payable. Therefore, at the end of the period, we have to calculate what taxes are. If we haven't yet made that journal entry, we would be debiting income tax expense. And assuming that we haven't yet paid that tax, we would credit income tax payable for whatever the amount is. Okay? So these are some examples of, just by simply looking at a trial balance, you want to train your mind to look at these accounts and realize here are some adjusting journal entries that might take place. It's not to say that they have, but you want to be aware of them as an accountant, or just as a manager, knowing that you're looking at accurate financial data. You should be able to ask the accountant, hey, have you made these journal entries? Has these taken place? Am I actually looking, what I'm basing my management decision on, is that accurate data? Have these adjusting journal entries taken place? Please let me know if you have any questions over E42.